Before we get started, I want to remind everyone that the information in this presentation is not to be or construed as investment advice. The information presented are subject to change without notice, and while we have made every reasonable effort to ensure that the content is reliable and accurate, we have not independently verified the content and are not responsible for errors therein. Please consult a professional advisor before putting a loonie in any of these financial markets.
Hi everyone, my name is Richard Diaz and welcome back to the IceCap Canadian Market Wrap. In this week's episode, we are going to, of course, tackle the most highly anticipated federal budget in a generation. It is 6 months late and not a dollar short, as it outlines the biggest budget deficit ever outside the COVID lockdown era. It's also long at more than 400 pages, so we won't be able to go through it in too much detail. We can and will touch on some key elements, some good, some bad, and some ugly, as well as a couple of issues that pose a risk to the rosy outlook on how your tax dollars are being allocated. But first, I love history and context, so pour one out for Chrystia Freeland, who fell on her sword to save Canada's future generations from profligacy and to keep Canada's fiscal powder dry. And keeping with tradition, delivering the 2024 Fall Economic Statement late and also 50% higher than was projected. Alas, how quickly we forget. Fast forward through worries about an imminent invasion, the election, the tariffs, the trade war, and any pretense of maintaining fiscal discipline whatsoever went out the window. The Carney election platform, the figures you see in yellow, make the previous Liberal government look positively austere by comparison. And the numbers released this week dwarf the campaign Carney election budget projections. Now, in fairness, there is a clear change in tone between the Trudeau budget deficit and the Carney budget deficit. Gone are the disparate measures sprinkled across different sectors and populations in the economy. Instead, there is a new focus on efficiency and reducing operational costs to fund big spending initiatives on infrastructure, defense, and housing, with the aim of reorienting Canada's economy from east to west and supporting business investment to, quote, supercharge growth and productivity. What remains is the same inability for this government to live within its means and a desperate lack of awareness that ever more government cannot cure what ails Canada, and recognizing that their interventionist streak is part of the problem. So how big is the budget deficit really? Well, here we have a chart from 1980, and we can see that it's the biggest budget ex the COVID lockdowns. The budget deficit is forecast to swell to minus $78.3 billion this fiscal year, up from negative $42.2 billion at the 2024 Fall Economic Statement. We'll discuss why this is likely at the low end of the estimate in a minute, but the deficit remains significantly elevated through the 5-year forecast horizon, falling to only $56.6 billion by 2930. The federal government also abandoned all pretense of its prior fiscal anchor, electing instead to target a balanced operating budget by 28-29 and a declining deficit to GDP ratio through the forecast horizon. That means by 28-29, capital investment should account for all new borrowing. Unfortunately for Mr. Carney, deficits by any other name are still new net borrowing. And at 2.5% of GDP, the deficit this year will be the highest since 1995-96, outside of recessionary periods like COVID and the GFC. All said and done, the budget 2025 adds or has added $141 billion in net new spending across 4 main areas, including defense, infrastructure, the already implemented tax cut to low-income households, and the new Build Canada Homes program. Big numbers were also thrown around for infrastructure measures, including a new $51 billion Build Community Strong Fund. While the program is new, the funding is not. The majority was a reallocation from other areas. In other words, the net budgetary impact for the program is only about $9 billion over 5 years. This reallocation technique was a general theme across the budget, although I will happily concede that deficit spending to fund infrastructure projects makes way more sense than spending on government consumption. Of the $141 billion in new spending, a huge chunk, about $100 billion, is accounted for by higher defense spending. Now, for years, Canada has neglected its NATO commitments, and so it's nice to see a government finally get serious about defense, especially given our newfound nationalism and all the hand-wringing about the threat to our sovereignty. Putting Canada on a path to meeting NATO's 3.5% defense investment pledge by 2035 will cost a fortune, but I think it's the right thing to do. As an offset, the government is conducting a comprehensive expenditure review, identifying nearly $60 billion in cost savings over 5 years. This is comprised of a reduction in departmental budgets, reflecting a 10% cut in federal public employees and other operational savings. However, let's keep things in perspective. For 10 years, program spending was growing at 8.1%, which is completely nuts, by the way. This new comprehensive expenditure review is meant to rein in government spending, but to be clear, spending will not be cut. It will just grow less fast, as you can see on the chart. This initiative takes aim at reducing duplications and efficiencies and, quote, realign activities towards the core federal mandate. But it also makes you wonder what the hell they were doing in the first place. One thing in the budget that is unambiguously good, with the proviso that they actually follow through with it, is the commitment to reducing public sector employment. As I've mentioned to you before on this channel, public sector employment growth is or was completely out of control, accounting for 41% of the job growth over the last 6 years, while public sector productivity languished at a 10-year low. There are too many passengers working cushy government jobs, and a cull is long overdue. Another major positive is the volte-face on immigration. After years of calling anyone who objected to the Liberal Party's wildly irresponsible open border policy a racist, it is welcome news that the budget outlined a much more sensible view on newcomers. They actually went so far as to throw the Trudeau government under the bus while committing to reducing temporary residents and targets negative population growth. Although I will hasten to remind everybody that the same people disavowing the old immigration policies voted for and implemented them. Switching gears a little bit, in the Budget 2025 document, there is language centered around Canada's strong fiscal position. Virtually everywhere this is mentioned is a reference to net debt. It is used as a cover and as a rationale for these massive deficits with no fiscal anchor. And I want to make this crystal clear. This figure that is paraded to justify these deficits is a lie. And I don't care what organization like the OECD or IMF parrot this nonsense. What is net debt, you ask? And why is it BS? Well, to calculate net debt, governments take gross debt and subtract pension plan assets. That means, in theory, liquidating your pensions to pay down federal government debt. Not only is this a morally bankrupt view of our finances, it's unclear if this is even legal. When you hear net debt, it should raise alarm bells. This brings us to the growth forecasts in the budget and how they might impact the evolution of gross government debt to GDP. We have mentioned before that the government technocrats don't forecast recessions, and they shouldn't. Well, you can bet your life that they don't forecast a recession in the budget deficit. Again, there are some good reasons for that, but it doesn't mean we can't be skeptical of their growth expectations. As you can see on the left-hand chart, the 2024 fall economic statement had unemployment falling, and on the right, the rosy forecast that underpinned those estimates. In 2025, the outlook is lower than last year, and again, the unemployment rate is actually set to fall. This doesn't quite make sense. And as we've said repeatedly on this channel, Canada faces a productivity emergency. So with no population growth, or even a population decline as a buffer, headline GDP growth will also slow dramatically. And of course, with Trump's protectionism certain to bite, Canada is vulnerable to some negative shock or global slowdown. With that in mind, it should surprise nobody that we feel that the downside scenario to the budget deficit estimates is by far the more likely path. And indeed, on page 265 in the budget annex, there is a scenario analysis that suggests a 1 percentage point decrease in real GDP growth proportional across income and expenditure components reduces the budgetary balance by $5.4 billion in the first year and another $5.4 billion in the second year. As you can see, it's clear that we're going to blow through that $80 billion budget deficit if anything at all goes wrong, and we expect it will. Related to the bigger budget deficits is the potential for much higher debt charges or interest payments, as seen in Table A1.7. Federal interest payments are already higher than healthcare transfers, and we expect this gap to widen again, and this is in the government's benign growth and interest rate scenario. As we bring it home, it's hard to admit, but there's actually a lot to like in this budget. Lower immigration, public sector employment caps, defense spending, a focus on capital investment instead of woke BS. There's also tax credits for R&D, machinery and equipment, as well as clear focus on mining and critical minerals. Unfortunately, at the end of the day, the government can only do so much. This is because of the simple reality that most CAPEX is sourced from the private sector. Canada is facing a productivity emergency, in part because the Canadian government has spent the last 10 years stifling CAPEX and scaring away foreign investors. This will take a lot of time to correct, and certainly more than just one budget. Productivity growth is the only sustainable way to derive long-term economic growth and to improve the standard of living of working-class people. Canada needs private sector capital to invest and the private sector jobs that come with it, not ever more government intervention, no matter how well-intentioned. Canada needs deregulation, lower taxes, and a regulatory environment that will encourage foreign and domestic private sector investment. And that brings me to the biggest disappointment in the budget, and it speaks to the dogmatic adherence to an ideology that would see Canadians get poorer. The budget completely overlooks the oil industry, specifically pipelines, the most obvious and accretive infrastructure project out there. Let's just hope it was a typo. All right, that's a wrap on this week's episode. Please like, subscribe, and follow for more. As always, we manage money for families all across Canada and the world, so please feel free to get in touch.